We are going to start the session shortly. Thank you for your patience. Good evening, ladies and gentlemen. Today, we are going to discuss a calendar spread strategy. So today, our speaker is Mr. Manoj Vyalar, a veteran in derivative market with profound understanding about the subject. Manoj has been spearheading derivative segment for Religare Broking Limited since last 9 years. Manoj has a strong hold on option segments, especially index option, which constitute lion's share in the overall market turnover. His grip on derivatives data enable him to foresee near-term market movements, and for this very reason, we are conducting this webinar. He will be supported by Mr. Gaurav Arora. Gaurav has recently joined Religare, and in no time, he has been our key resource to generate short-term investment ideas. BTech by qualification, Gaurav has a good understanding of charts, and his ability to understand data has been contributing significantly towards wealth creation for our clients. Gaurav focuses on the stock future and stock option sides of the derivative segment for Religare Broking Limited. I would like to invite Mr. Manoj and Mr. Gaurav for the subject training intervention. Mr. Manoj, over to you.
Thank you, Swaraj, so much for the beautiful introduction, and good afternoon, everyone. So thank you for joining this webinar where we'll be discussing what exactly is the criteria that we are trying to discuss in this specific strategy. So before we start, there is a small presentation. We have divided the presentation into scenario analysis also. Now, because this is an index strategy, necessarily we are doing it for the Nifty index and not really on the Bank Nifty or any other index. So we have tried and found out that how the strategy would perform in 3 scenarios. So the portfolio or the PPT would go first with the basic understanding as to what exactly is a calendar spread and why or how we can use calendar spread to our advantage, if I might say that. And because this might be done on a weekly basis, and preferably we'll be doing it on Tuesday. So why Tuesday, why this spread, and how this might help the index, especially your Nifty trade. And the most important thing, how does it help in generating revenue, obviously, and how the clients can benefit out of this. So first thing first, we all know that the market has corrected a lot, around 15-16 odd percent, and this is a time when the volatility would be testing everyone's patience, because let's say even in today's trade, if you are buying a plain vanilla option, be it a call option or a put option, likewise, we see that the swing in the market which happens in the opposite direction is good enough to take away more than 50-60% of the option premiums that the client holds. So now that gives us a need or a food for thought that why exactly would we be shifting from a plain vanilla or maybe just an option buying to something called as a strategy, or which we call as spreads. So first thing first, we all know the basics of index options would be when you buy an option, be it a call option or a put option for your index or a stock. We need to pay the premium and obviously the lot size associated with that underlying. So in this case of Nifty, let's say the Nifty, we all know the Nifty has a simple lot size of 50 rupees. So whatever premium, let's say if I end up buying a premium of 100 rupees, be it call or put option, the amount of money that a trader has put into the market with that particular instrument, which is your index option, would be 100 rupees into the lot size, which is 50. So that comes to 5,000 rupees. Now, obviously, it looks very lucrative. That 5,000, that's hardly any money. If you have to look into the depth of what the stock market offers and the reward it offers. So 5,000 hardly would be any money. But then it also, we all know that risk and reward go hand in hand. So obviously, there is a risk to this 5,000, especially because it's an option. Needless to say, a stock option or a weekly option or an index option. Now, because the index has a weekly expiry, the next 5 days of trading, if you're on the right side, obviously the option helps you make money, or else it goes into a loss. So that gives you the need that we might go a step ahead from a basic plain vanilla. When I say plain vanilla, because that's a basic thing that you get in an derivative tool of an index option. So rather than just buying, let's say, call or put option, we try to strategize a bit more, try to understand a bit more, because there are certain parameters. We all know, people who are into this option trading for more than 2 3 odd years would know there are a lot of other factors, not only about the underlying. There are other factors, as in the time to expiry, the volatility, and the strike price that you select to buy an option. These things can help dictate the reward or the amount of money you make or lose also, likewise in the market. So obviously there are many strategies. The need for strategies comes into action because there might be clients who would be trading in the market to make some money out of the volatility that is there in the market. There would be clients who would want to trade on the direction of the market, and there would be clients who would want to trade in the market just to be in the market and try to make money by the Nifty being in, or the index being in the range. So these are three primary things. Based on this, the strategies comes into action. So now this, in today's webinar, what we're trying to understand, or what we're trying to discuss is what is the USP or the unique point that we have for this strategy, and how does it help into the Nifty, especially because it has got a weekly expiry. Now, one thing I always say, people who usually have heard me, that derivatives, the best part about derivatives is every term is self-explanatory. You need not really, garner any internet Google to find out what this strategy would mean. So before we go ahead, the criteria that I would again want to dictate here is, we would strictly do it for Nifty, because there is certain basic calculation that has been garnered maybe a good 6-7 years to understand why this would help. And we all know that the weekly expiry for the index started, I guess, 2.5 years before. So how it has helped in understanding this. So as I said, there would be a small presentation, so I'll just go through that, wherein we will try to explain the best that possible for this, and why this strategy stands out. So as I said, as the name suggests, the word calendar, we all know that the basic meaning of the word calendar is it has to do with the time, that is your dates that you have. So in this, now because it is a spread, it is but obvious there are two positions or maybe two options which are involved. Otherwise, it would be a plain vanilla call. So a calendar spread, as the name says, would be two options with different expiries that is taken into consideration, and the net off is either taken as a profit or a loss. So what it means is, as I said, the first line itself says that because we have two expiry dates, and in this type of strategy, we are necessarily taking two consecutive week. That is, let's say we know that the coming Thursday would be the weekly expiry for 23rd June. And then we have the monthly expiry, which comes on 30th June. So whenever we do a calendar spread, we would necessarily be taking this consecutive weeks and not really going beyond that. Obviously, you can take a 23rd June and go for a far month, maybe a July expiry as well. Even that counts as a calendar spread, because you're using two different dates. But here, the entire research that we have done over the time, that how a two consecutive expiry can help you, is what we'll be trying to say in the presentations. So as I said, we are using two consecutive expiry, and that is exactly why the name says that it's a calendar spread. And in this, simultaneously, we are using the same strike. That is, we are given an example here, just to tell you that we have taken a 15,900 strike. Here we are assuming that, let's say the Nifty is at 15,700. So 200 points away, 15,900 strike is being selected both for the coming expiry, which is 23rd, and the next consecutive expiry, which is the 30th. Now, the most important thing that every option trader must have faced is when you buy an option, and unfortunately, if the market does not move in your direction, the premium starts falling. And the fall in the premium can be a good 10-20% to an almost 100% if unfortunately you are totally on the opposite side, that is during expiry. But when we incorporate spreads, there are certain parameters which helps in our favor, irrespective of the view that you have in the market. So what we're trying to assess here is how a calendar spread is as good as having an option plain vanilla call, and which gives me a security for almost 50% of the premium. So what I'm trying to say is, let's say if I buy a call option of 100 rupees, irrespective of where the market goes, it assures me that till the time my option goes down to 50, I'm not losing money. If I can get a scenario like that, obviously in such a market where volatility is like just peeping around every minute that we see in the index, I guess this should be a very good strategy. And that is exactly why we are trying to understand by doing this on Monday, because tomorrow would be the first day, preferably, that we will be coming with the first weekly calendar spread, and from there on every Tuesday we'll have a calendar spread going on. So for this is a typical example. What happens is, let's say even today the Nifty has closed some close to 15,350, or let's say a 15,400. So if I have a bullish bias, or if there are certain parameters that I calculate, we believe as an analyst that maybe a 200 to 50 points of move has to come in. But because if I simply buy a plain vanilla call option, which we usually do, the risk is higher. There is an overnight risk what happens in the US market and the globe across, and then the gap up or a gap down opening next morning, that hampers or takes a lot of premium from the plain vanilla buy. So if you see in this scenario, I have taken an assumption that, let's say the Nifty is at 15,700. That is the spot Nifty I'm talking about. We all know that as on expiry, the option premiums are calculated for in the money option based on the spot closing of the Nifty index and not really on the futures. Yeah, it's understood that the futures and the option and the spot coincide with each other as of 3:30. So a typical example, as I said, is we will be buying a 30th June. So this is called a far week option. So we are buying a far week 15,900 call option at, let's say, 130 odd rupees, and we are simultaneously at the same time we are selling at 23rd, which is your 2 days 3 days away, June 15,900. Just we need to see the strikes are the same. It's the same strike 15,900, but only we are buying a 9-day ahead, excuse me, a 10 days ahead expiry, and we are selling at just 2-3 days ahead expiry. So the spread comes down to 60 rupees. The price is 60 rupees and the spread comes down to 70 rupees. So now obviously it sounds like any other spread, like there are a lot of call spread or ratio analysis or maybe butterfly types of spread that is being done. So what is the USP of this, and how does it help on a Tuesday? Now if I go to the second slide, this is where we try to make it a bit simpler. So obviously the three scenarios that every trader faces the moment he buys an option, irrespective of call or put, is there is a movement in the Nifty. One is in his direction, one is exactly opposite to the direction that the trader has bought, and the third is it is in a range bound market. So in this scenario, if you see, we have assumed that the Nifty is at 15,700. I hope everyone can see the screen here. And we have bought a 15,900 call option for the next week. The premium is roughly 130 rupees. And we have sold a 23rd same strike 15,900 for the Nifty call option at 60 rupees. So 130 minus 60, the difference, the spread difference comes at 70 rupees. Now, this is just a table where we have explained each scenario in each page, as in how, what are the parameters which comes into play. And believe me, this is more of an objective analysis than subjectivity. Yes, there is some subjectivity as to at what time the Nifty might fall. Is it on the day itself, 2 hours from the time you've taken a trade, 2 hours before the expiry? So, timing of the Nifty going up or down is obviously that no human on this earth can be sure about. But then the levels are where we are trying to put the objective analysis and to help understand how this would help. The most important thing, what I feel with my experience over this year is this is one strategy which can be used as a regular income strategy. So what I mean by this is, obviously the Nifty has a weekly expiry going on, and we have almost sure that it would not stop because the volumes are doing good in the National Stock Exchange, and that's good revenue for them. So this weekly expiry which is there every Tuesday, if you simply say that after Thursday, if you divide the next coming 7 days by half, Tuesday is exactly the center of the week. So you have 2 days, which is Friday and Monday before Tuesday, and then you have Wednesday and the day of expiry, Thursday. So Tuesday happens to be the pivot, if I might say that, because a lot of option traders would understand this jargon. A pivot is simply a level above which you can consider a scenario and above which the scenario changes. So at any level, if the scenario changes, that term is used as pivot. So in this case, we have taken three scenarios. One is if the Nifty is down from the time we have bought call option. The second is in a sideway, and the third is obviously it is up. So if you see what happens is, we all understand that this 23rd June 15,900 strike call option that we have sold for 60 rupees, this has a tick, or maybe the life of this option is still just 2 days, because assuming today is Tuesday, so Wednesday and Thursday, within these 2 days, and the Nifty is 200 points down. If you can see, the strike we have selected is a 200 points up from where the Nifty is currently. So assuming 15,700, we have taken a 15,900, and the premium is 60 rupees. So we are selling this option. Now, obviously, the simple, what do you say, the trend that a call seller has in mind is when he is expecting the market not to go beyond his strike. But in this scenario, if you just rewind and if you see the first part of the strategy, we have bought a 9 days ahead, which is the expiry after 23rd, which is your 30th June expiry, the same strike. And obviously, we are paying more than double money for that, 130 rupees. And the net spread comes to 70 rupees. So I'll just take the first scenario wherein we'll discuss exactly how this helps and what are the margin and the risk involved. Obviously, there is a risk to every strategy on this earth, be it option or a future or any underlying. The only thing is we're trying to mitigate or say that the risk is defined or it is under control, or we can see where the strategy can be exited with minimum loss. So that is obviously the first thing, that this is not really an assumption. This is something which we have taken into consideration before we try to analyze on this. So the first scenario says that now we're just going to basic. You buy a call option when you are bullish on the market, that is, you're expecting the Nifty. The reason I'm using Nifty is because we will be doing this only for Nifty. So if I'm bullish on Nifty, the meaning of bullishness is I'm expecting the Nifty to go up from where it closed, or from the time I buy that call option or we buy that call option. So assuming that the Nifty is at 15,700 and the 900 strikes have been bought, if the Nifty comes down by 300 points, so there are two scenarios. Now, this is an option which has almost 9 days or 7 days to expire. So obviously, it will have some premium because there is good 7 days of probability that it might again bounce back. But what happens to this part? The 23rd June, which is just 2 days ahead, the premium of this call option starts falling more than the amount by which this would fall. So in this scenario, when the Nifty is down, and this is the Tuesday, on Thursday when the Nifty is down, so let's say it was 15,700 and the Nifty is come down to almost 15,400 or 15,500. So this call option, the entire 60 rupees becomes zero, because obviously it is out of the money, and there is no money for out of the money, and it gets squared off even if it is led to expire. We need not get into a sell trade. So this entire 60 rupees is pocketed by the seller, because we are a seller of this call option. So the second half of the trade, that is, we are not expecting the Nifty to go beyond 15,900, works in our favor, and we get that 60 odd rupees. But then what happens to the first part, wherein we have bought the bigger premium, almost 130 odd rupees. So yes, because it has another 7 days. If you see the difference, this is 23rd, that is, we are talking as in 23rd, but this option has got another 7 days to expiry. So from 130 rupees, it might fall down. Certainly, it might fall down. People who understand derivatives more, options into detail, there is something called as a delta. Delta of an option is simply the amount by which the call option or the put option would increase if the Nifty goes up in terms of call option and if the Nifty falls down in terms of put option. So this 130 odd rupees is not going to become zero because we have 5 more days to expiry. That is the next Friday, Monday, Tuesday, Wednesday, and then the 30th day. So even if the Nifty corrects by a good 200, 300 odd points, this 130 rupees could exactly half or maybe more than half, it would go to 60 odd rupees. So in this scenario, what are we losing? We are gaining 60 rupees because we have sold a call option. But in this bigger option, we are losing a 70 odd rupees. So net, maybe 10 to 20 or 15 odd rupees based, depending on the volatility or the time we square off. So I would take an average of 10 rupees in the strategy is what we lose. Now, obviously, it's a loss, no doubt about it, it's a loss. But then look at this part. This is a strategy where 300 points of Nifty against your view has happened in the market and you end up losing only 10 rupees. And the risk that you have taken in the market is quite minimal. Why? The reason I'm saying the risk is because if you have sold an option, you have also bought the same option. But on the flip side, if you're totally wrong on your view, if a Nifty goes down by a good 300 odd points or a 200 odd points, all you end up losing is a good 10 to 20 odd rupees, which is a very low risk reward in terms of the volatility or the VIX giving you a swing of 200-300 points every day, and then there's a gap up and gap down which happens. Now, the simple thing is, how does this work? Why do you think this is a better strategy than any other strategies? Because what happened, as I said, Tuesday is the half of the week. So if things do not, in terms of call option, if the things do not work in a bullish way, that is, if the Nifty is at, let's say, 10,000, and I have a 10,100 call option, which is after the money call option, then the Nifty does not move bullish because it's a call option, I start losing money fast for the expiry which comes first. So the first expiry, that would be 23rd. So that is how this ends up becoming zero. And obviously the price of this also goes down, but this helps me cushion that fall, So if it was just a plain vanilla buy, just let's assume another scenario that I bought a 30th June 15,900 call option 130 rupees. And if I'm down, if the Nifty is down by 300 odd points, I end up losing 70 rupees here. So 70 is almost half of this, So 50% of your principal or your capital is gone. Now, obviously, that is a big risk that a client has to take. If the reward has to be more than 2 times, generally 1:2 is the risk reward what market participants do. But in this case, just by incorporating a sell on the same strike for the near strategy, I'm cushioning that 70 rupees with a good 60 rupees, and the loss is hardly 10 rupees. So in this scenario, the other good thing, the second USP which I would say for this strategy is, generally when you sell a call option or a put option, based on how the Nifty has behaved, the margin needed is at least an 85,000 to 1 lakh odd rupees. So let's say Nifty is at 15,400 as of today. So if I'm selling a 15,600 or 15,500 or 15,700 call option, just selling a call option, no other strategy, just a plain vanilla sell call option, or selling a put option, maybe 200 strikes down, I need to end up paying 80,000 or maybe 1 lakh rupees for that one lot of Nifty options that I'm selling. But when I'm doing the same here, when I'm selling that, when I'm buying the next week as well, the margin falls or comes down to as low as 22,000. See, because obviously this is no discount going on in the index, but the simple understanding is the risk is only for the time. The risk is not for the direction. That means if there is a trade wherein the trader has sold an option, he has equally bought a far weak expiry option also. So the risk is not in the direction, the risk is in the time, which is a 2 days. So the margin falls by 1/4. If by 4 times, I would say. So an 85, 1 lakh rupees, it reduces to 22,000 rupees. Now just imagine if a client, let's take a scenario where the client has got 1 lakh rupees. So if he's just selling an option, first of all, the risk is high because there is no cushion to his, and it has to be exactly proper to what analysis he has done to the trade. That is, if he sold a call option, the market has to take a resistance for him to make money. The second is he ends up maybe involving, if I would not say risking, involving an 85,000 to 1 lakh rupees for that one lot he is done with the index or with the broker. But in this case, because he's bought a 130 or a next week option and he sold one, the margin falls to 1/4. So with that 1 lakh rupees, he can do this 4 times. So if you see, with that same 1 lakh rupees, what a client could do for one lot, if he is cushioning it with the same strike, but a next week option as well, the margin falls down and he can do 4 times it. Now this is where the monthly income, which I said, would come into play. Now what happens is, obviously we all know there are different types of margin that comes in. One movie, you have a simple cash margin, then you have the haircut on the portfolios and things like that. Irrespective of whatever way we have the exposure for a client, if I can do the same trade with the same direction and with 1/4 of the margin, obviously, and the risk goes down to maybe a 50 odd percent, and the margin comes down by 1/4%. Now this all looks good because we have taken a scenario where the market is falling. But now we'll be looking into other scenarios as well. What happens if the flip side happens? How does it work in that way? So if you go to the second, before we go, I just mentioned one line. So let's say in today's market, if the Nifty falls by a good 300 odd points, every analyst or a trader happens to change his view. So in this case, he would not be involved or stuck with the strategy because he's just losing a 10 odd rupees, and then maybe the calendar call spread has not worked. He can reverse it and get into a put spread also. So that is one thing, that you're not stuck with the strategy just because you have gone wrong. The loss is minimal, the margin is 1/4, and the risk is 50%. So now we come to the second scenario. The second scenario is sideways market, which is always conducive for option sellers more. So here we try to see how exactly does this profit, because we have also got an option. In this day, the 2 days to expiry for this 23rd 15,900 strike. Now that acts as a, what to say, a plus point, because as I said, the biggest thing that we have is this option has the 9 days to expiry. This option, the other one, has just 2 days. So obviously the 2 days option tends to grow more towards the zero side and it becomes zero. Excuse me. So if the Nifty is sideways, on Tuesday you have executed this trade. So on Wednesday and Thursday, the same analysis, the Nifty is at 15,700 and the strike you have taken is 15,900. So even if the Nifty goes up by 200 odd points, this option as of 3:30 evening PM Indian Standard Time, it is going to be zero because the expiry is just at the strike. So even if the market goes up in your direction, but if it is not rapid, what I mean by rapid is, if you're done a trade on Tuesday, it has to move on Tuesday the minute you do it. Otherwise, if it is going to be slow, this sell option starts giving you money. So it's like a ticking bomb. The moment you hand it over to other, you start benefiting because the risk is gone from your side and it is gone to the buyer. Now, but on this side, we have been a buyer also, but then we have a bigger expiry date. We have another 5 days more of probability for the Nifty to come back and give us the money. So in this scenario, if the Nifty goes into a range bound session, let's say 150, 200 odd points, this 60 rupees, because the expiry is ticking and it is near, this tends to become zero first. And the far week expiry, which is your 30th, that would reduce. Obviously, it will reduce by 10, 20, 30 odd rupees, but still, because you have gained 60 and you are losing, let's say 20, 30 rupees, you're still ending up make 40 rupees. And again, the most important thing is this, the risk is less. And as I said, you know, the margin is almost 1/4. So if I simply compare that to any strategy where I've sold a call option, because a lot of clients, they are selling a lot of call option, put option, which is very good, because you know, provided we understand the nuances of the market, where how an option, what to say, the premium changes with the change in volatility, the change in time, the change in Nifty, and even an overnight change in the date. So these 4 things is how the option premium affects. But in this case, it takes away almost 2 to 3 parameters. You know, if I might not be wrong to say that this would be more like driving an automobile with an automatic gear, where you need not worry about a clutch and gear, because this takes care of the gear shift changes. So as the day progresses, you need not calculate what is the amount of premium I might lose or I might gain. So this thing would take care of that. So in the second scenario as well, when the Nifty is sideways, or if it goes up to the strike at which you're selling, we usually do it for a 200 points. See guys, one thing is that there is a match to everything. So it's not just basic that if the Nifty is at 15,700, we buy at 15,900. There are times when we go to a nearer option, which is 150 points away, or maybe a bit far, 300 points away. But generally, we are between that 100 to 300 odd points. And in this example, we have taken 200. So there is a match to that. We are not going there as of now. But the simple uh, logic, if I might have to say, is if I have something which is worth 60 rupees, and if I know in next 2 days it is going to become zero, I can simply assume that the worth of that thing is 30 rupees for a day. It is simple math. That is, you divide 60 by the number of days to expiry. That is 2 days. So I know one option, if the Nifty does not go or move rapidly, it is going to give me 30 odd rupees. So that will help me cushion this big option that we have taken. So this is one simple logic that we take. Then there are certain calculation to Vega and data, where in detail, if needed, we will let you know for clients who have done that. So the second scenario wherein we expect the market to be sideways. Now this goes towards a zero faster rate versus this, and it ends up making 40 odd rupees. Now, the best part is, guys, this does not restrict here to Nifty as well. This can be done for many underlying, like a currency or a gold or commodity like that, in case there is liquidity. But then there are certain maths we need to apply on the strike that we select and the number of days to expiry that we have. Now, the third scenario, that is, we have bought a call option and we have sold a we have bought a next week call option and we sold a this week call option, and the market starts going up. In that scenario also, we end up making money first, but then there is a limit to it. So what happens is, we are expecting the Nifty has gone up immediately 300 points from where you have done this strategy. Now this buyer of the option is all fine, but what happens to this? Because when you sell a call option and the Nifty moves rapidly from the time you sold a call option, obviously the premium is at risk. So the smaller premium is at a risk, but the bigger premium is at a reward. So that ends up giving you again profit. So what happens is, let's say the Nifty goes from 15,700 to 16,000. So it has moved by 300 odd points. Now, because it is expiry, 15,900 call option that you sold at 60 rupees, it would increase to 100 rupees. So that is, you lose 40 rupees on that, because you sold something at 60, and if it goes to 100, you end up losing money. So what is the money you lose? You lose 40 rupees. But on the flip side, the first half of your strategy, wherein you have bought the next week option, now because the next week has got 5 more days to expiry, the amount by which this would increase will be higher than what this would happen. So that 130 odd rupees would end up going to 200, 210, 220, depending on where the VIX is and what time of the Thursday that we're talking about. But net we end up making 80 rupees from this, and we lose 40 rupees from this sell option. So still we end up making 40 rupees. So guys, now this is a simple strategy for a simple scenario that we have put for three things. Now, very how to say, neatly, if I have to say, what is the difference this does, a call spread does not, maybe a put spread does not, or a butterfly or a ratio spread does not, is, see, the most important thing is we are selecting the same strike. When we select the same strike, the risk of Nifty, let's say, mitigates, because even if I've sold an option, I'm buying an option of the same strike. So whatever calculation I might lose because of the Nifty going beyond a 15,900 will be compensated by the same strike of the next week that I bought. So that's the first thing. Now the second thing is, obviously when you sell an option, you need margin. So the span, the risk in the strategy comes down to 1/4 to just selling an option. So that 85, 1 lakh rupees, or that you need to sell one option, maybe a call option or a put option, comes down to as low as 20 to 25,000. So as a client, I can, let's say if I'm expecting the market to go up by 200 points, what I can do is, I can ask my client to sell a put option out of the money strike. But when he does that, if he's selling one lot, he's engaging or he's locking up a 1 lakh rupees with the broker, because that's the margin required as per what the exchanges say. But in this scenario, I would do a call calendar spread. So what I'm doing is, I can make him do 4 times the same quantity with the same 1 lakh rupees, which gets blocked, or maybe which gets engaged by the risk management in the company. So how it helps is if he ends up making 50 rupees in the put option, even if I'm making 20 rupees in the call spread, because I do it 4 times, that gives me an 80 odd rupees. With the same money, I end up doing twice or maybe more than 120% to what I would usually do when I'm simply selling a call option or a put option. So, and second part is Tuesday is the day we need to do it. And guys, the most important thing, do not do it on Friday. Do not think that maybe twice it has worked or 3 times it has worked on a casual day. You just feel that, oh, Monday it's a good day, I can start my day with a calendar spread. No, there is a reason why we select Tuesday. As I said, okay, if I have to simply say that there is a time decay or maybe the amount with which the option comes down. So if I calculate that break even to the number of days involved, Tuesday is the day where I should be doing it ideally as per maths and statistics. So when I do this Tuesday morning, it automatically starts coming down in terms of the premium that when I'm selling for the near month. And even if the Nifty moves in the direction of the call, the next week takes care of that. And obviously, in a scenario when we are absolutely opposite, or maybe the Nifty goes away 300 points, so we end up making losses, no doubt, but the loss is as minimal as 10. So if I simply compare, the put seller would end up losing maybe 100% of his margin if the Nifty comes down 300 points. If he's selling a put option of 50, that would end up becoming 100 or something more. So the risk is twice that. But in this case, I would end up maybe, let's say, losing 10 rupees. The second scenario, when it's a range bound market, the put seller would end up making 50 rupees. Yes, but then with his 1 lakh rupees, he can do only one trade, one option, one lot. But with that same 1 lakh rupees, I can end up doing 4 times that. So if he's making 50 rupees, and if I end up making, or I, in the sense, the trader end up making 20 odd rupees in one strategy, he still makes 80 odd rupees. The third is, if in the scenario when the Nifty goes up, the put seller, obviously he will make money faster because the first day he will get more option, more premium versus this spread. But the amount at which I can do with the same money again is 4 times. So simply, if I have to say what is the USP of this trade, is this trade gives you a cushion of 300 to 350 points when you're absolutely royally wrong in terms of analysis, which is a big thing because the market is very volatile. So it takes care of any trader with a 300 points cushion, which is one big thing. The second point is the margin needed is 1/4, so it allows me to make more yield. It gives me more money to the, it gives me more profit to the same money involved in the trade. That's the second part. And at the third part, third most important, the risk is down. Where I'm selling a call or a put option, when I have an overnight scenario and things happening in the globe, at least the peace of mind is there. Now, obviously, the risk and the reward goes hand in hand, but because the margin comes down by 1/4, this is the most, or maybe I would say the best strategy to be done on a Tuesday of every weekly Nifty expiry with a strike separation of around 150 to 200 points. The maths, we will decide on that. But these three unique points is where this takes you to a profitable mode, irrespective of where the market is. Now, let's say maybe 3, 4, 6 months, I'm assuming that if the market is all stable, even at that point of time, the volatility might be less, but the margin of 1/4 will make you do it 4 times. In the second scenario, when the market is down, when the market is bearish, or you have surprises every other day, the volatility would not give you a peace of mind, or the risk is more. This strategy will give you the risk with 1/4. Third is, obviously, the entire thing is done so that the client makes money. So with the same margin, that is 1 lakh rupees that an option seller needs at this point of time, as per the span and the volatility that we have in the market, this allows you to do it 4 times with that. So we believe that this is one strategy which has been tried and tested, and it becomes a source of a monthly income regular strategy also. So what I'm trying to say is, when we get into tune with this every Tuesday, and when the report starts coming in from the research desk, and we will be doing it possibly tomorrow also. So even if we have if you're, let's say let's say we're doing a call calendar spread and the market is down 300 points the next day or immediately tomorrow, even then we end up losing only that 10, 15 odd rupees. The two scenarios where the market is range bound and the market is rallying, we end up making the money. And as I said, because the margin involved is 1/4, the money is 4 times that what a regular option seller. So I'm sure there are a lot of traders who sell options A lot of traders who buy option and believe this strategy is actually a combination of a seller and a buyer. And because we are taking the same strike, it mitigates the nifty risk, it mitigates the time risk because we are doing it on a Tuesday. And obviously when things cannot be so rosy on every aspect, the reward would be lesser than a plain vanilla option, that is obvious, but then the risk is much lesser than a plain vanilla selling call option also. So I guess these are the three most important aspects about this. Now, as I was saying, I've just mentioned there about this margin, that since it's the same strike that we have bought for next week and we have sold the current base, the margin generally is around 20. In this scenario, I guess it's around 23 or 24 odd thousand versus around 90 odd thousand that you need even now for selling an option as of Monday. So this can become a regular product, as I said, because the multiplier is 4. So if a client has a margin of 1 lakh, wherein he ends up selling just one option, with the same money, he ends up doing 4 times a trade with lesser risk, lesser volatility, and more probability of making money from what he does by regularly just selling a naked call or a put option and trying to be right always, irrespective of what the market goes up. So I guess. These are the main USP points. So again, I'll just underline the three things. How, because the first thing people have is, how does it stand out to other strategies? It stands out because the nifty risk is less. How is it less? Because the strike is the same. Second, how does it take care of the volatility? It takes care of the volatility because we have a combination of sell option as well as buy option for the same strike, for the same nifty. The only thing that we're altering here is the week. We are selling a near expiry and we're buying a next expiry. And third, thankfully, the margin involved by the exchanges and the broker here is 1/4 to what you need if you have to simply sell an option. So this takes care of, this helps me do at least a 2 or 3 multiplier. So even if I make half of the money by doing this than what I would do by selling a naked option, this gives me the probability of making profit twice or 2.5 times what otherwise the margin would be needed for. I guess these are the main points. Now, Swaraj, if you could just help me assist if people have some queries on this. Obviously, tomorrow we'll, I guess there are chances that we'll have a first calendar spread. Obviously, no guesses, not sure that this might be a call spread, but possibly it looks like it might be a call spread. So tomorrow we would decide the strike difference. That is, should it be a 200 points or 150 or 300 odd points, and the match behind it, and then we'll be doing that. And even if we are wrong, this scenario will work on this, and we'll see. So once the client sees that in all the three scenarios this work, I guess this is one USP of a strategy which has to be done. The beauty of this strategy, as I always say, is the strike is the same. The time decay, the fall in the premium gets to your advantage, and even if the Nifty rallies or goes in your direction in a very faster rate, you first end up making profit, take your profit, comes out, and third, the risk is less. I guess that's it. Swaraj, if you could help assist if there are any queries on this.
Perfect, Manoj. Thank you so much for this wonderful insight about this new product that you have come up with. I'm just opening the forum for the question and answer. So all the participants are requested to type in your question in the Q&A section so that we can address your queries one by one.
So do I?
So Manoj, we have a question out here.
Yeah.
From Mr. Amit Kumar. He just wanted to understand the quick way to calculate break-even max loss, max profit.
Okay. Amit, now obviously the only difference or the only criteria that this differs from a regular strategy, as I said, the scenario of a subjectivity. That is, we will be doing this on Tuesday, I guess the first half of Tuesday. So if the Nifty rallies in the first half itself, a Wednesday or a Thursday, the scenario changes. But a simple way is, because the expiry comes on Thursday and we use that as a benchmark to calculate, when we use the same strike 200 points away, for every let's say 120 points of Nifty movements in your direction, that is if you are about a call calendar in the bullish side, if it's a put calendar on the bearish side, 100 points Nifty would end up giving you around 14 to 20 odd rupees profit on Tuesday. The moment it goes to Wednesday, it becomes a 40, and then Thursday it would be 60 rupees.
Okay, fantastic. So I hope, Mr. Amit, you got your answer. So we have got our next question from Mr. Sahil Mehal. When not to trade a calendar spread?
Okay, when not to trade, you should not be trading a calendar spread on Friday, Monday, Wednesday, and a Thursday. Now, the reason was I said is because when you're selling an option, you need the option premium has to be healthy enough to take care of the bigger call option that you bought. So, an ideal day or an answer to this would be preferably do it on Tuesday. Now, because this is weekly, the second step is we'll be doing this for monthly strategies also. But before we go to monthly, start practicing it on Tuesday, the first half. And more than the date, we also look into the net movement of Nifty. There is some statistical calculation, but if I have to simply answer, do it on Tuesday, the first half, and select the strike to do it.
Great. So we have got a question from Mr. Vinod. How to place order with 25,000 rupees margin?
Yeah, you don't have to place an order because obviously even with Religer, the RMC calculates the risk needed or the margin needed. I guess your business RM would be in a better place to say. So if your client has got a 25-30 margin, when you're placing these two orders, I guess it can be done simultaneously. Maybe the business guys can help. What I'm trying to say is the margin requirement from the RMC and the exchange norms would be around 20 to 25,000 rupees. So if you have around 20-25,000, 1 lakh can be done for your clients.
Perfect. So I hope, Mr. Vinod, you got your answer. Thank you for asking the question. Again, we have got a question from Ms. Renu Gupta. The question is, should we do this manually or you have some special software so that there's no time lag risk?
Yeah. Now, Renuji, I guess, see, the time lag concept comes when you have a very high fast frequency algorithm or maybe an arbitrage running. So in this option, it would practically take maybe 30 seconds to select the strike, put the order, and then come to this. So the Nifty, see, even if the Nifty goes up or down in this 30 seconds, there is an opposite trade you're doing. That is, when you're buying an option, you're selling an option as well. So this would not be any software would not be needed, but yes, I guess there are Odin wherein we have a ready-made strategies for call spread also, so that it would have an option called as calendar spread. Now again, this your dealer would be in a better place to tell you exactly how that can be done. But manually also, absolutely it can be done. There is no time lag. Even if you take 2, 3, 5 minutes, this is not going to run anywhere.
So we have got another question from Mr. Manoj Sala. Yes, sir. Which order we need to place first to get the margin benefit?
Okay. Now let's put a scenario analysis. Like let's assume today is Tuesday. Today, what happened is the first half was positive, then we had a dip, and then we saw the market come into the second half, but no new high or no new low was made. So if I have to say, because it is Tuesday, I would first be selling an option because that is one to be done. And the second, I would not really say a disadvantage, but when you buy a next week option, that tick size, the impact cost is the difference between the best buy and the best sell that happens for a certain quantity. So that is a bit spread. So first is try to buy the next week option, which is a 30th June, and then this week, obviously, because the expiry is near the liquidity side, so sell the option second. First is try and buy the option for the next week.
I hope, Mr. Manoj, you got your answer. Thank you for asking the question. So we have got a question from Mr. Mohammad Imran. Can we play monthly expiry of same strike price?
Yeah. So, Mohammadji, what you're asking is a very good question. As I said, now obviously in calendar, maybe an expiry month, we have two types of month. One is a 24-26 day and a good 30-35 day. That is expiry to expiry every Thursday. So for monthly, yes, this can be done. So what we would do is preferably we have an 18th to a 24th day off from the day of expiry. As I said, this would be the second add-on that will come after once the weekly expiry is set in. We will do a monthly expiry also. Now, because you have asked the question, I guess you have been doing this. So better strategy here is what you'll do is you will in this scenario, let's say today the Nifty is at 15,400 and you will first is buy a 15,500 or a 600 next month, July option, and you'll keep on selling every week option. That is 15,600 strike for 23rd. After the 23rd expiry, you go for the 30th June. After the 30th June, you will go for the 7th July, and so on. So this is one strategy that can be done. But as of now, I would say stick to the weekly expiries, because there is a maths that comes in. So if I have to simply say, if the VIX is below 18%, 1/8, if the VIX is below 18%, and the strike selection is more than a 200 odd points, a premium of 50 to 62 rupees, this 12 rupees is a very good buy, because that ends up going to 130 odd rupees. Anything less than that or higher than that would not be suitable at this point of time. So this should answer your question as well.
Great. Samresh Kumar, a question from Mr. Samresh Kumar. Sir, can we make more strategy like this on weekly basis, and please give training and teach us, and also give us option selling?
Yes, can we make more strategies? As of now, yes, the research, these strategies would be coming from the research side, and you will be getting it through your RM dealer and the business side of Religare. On the weekly basis, yes, this would be a regular income, because we'll be doing this every Tuesday from here on. And the good part is every Friday also we'll be doing a theta decay strategy. That's the second that will come into play. So as of now, yes, it will be done every Tuesday. And for the training, yes, just write a mail to your business, because we'll be conducting option trainings as well.
Great. So team, all the participants are requested to, if you have any question, requested to type in the Q&A section. So as of now, most of the questions have been addressed so far.
Okay. So even if there are any queries, because tomorrow possibly you'll be sending in the first strategy, so the email is mentioned, or your respective RM or BMs, you can send in the queries which comes to me, and we'll try to answer this. Based on the profit booking that we'll do on maybe couple of days, or maybe exiting the trade, not only on the profit side, if it has to be an exit, maybe also. So that would happen in 2 days, that is immediately on 23rd of June, which is your expiry. So based on that scenario, if there are any queries, kindly write into us, wherein we discuss this at length.
So in the meanwhile, before proceeding further, I just have a quick poll regarding this session. So all the participants are requested to, share your opinion, share your valuable feedback. That will be a great help for us. Great. Just 2 simple questions. So all the participants are requested to participate in this quick feedback form that we have published right now. Your valuable feedback help us to grow more. If you have any questions in the meanwhile, request to type in the Q&A section so that we can address your query. We are going to end the poll in next 1 minute. We're going to close this poll. Thank you for your feedback. So before closing the call, we have got a question, Manoj, from Ms. Renu Gupta once again.
Yeah.
This can be done as per view, without also?
Without a view, it would not really help, because what happens is you lose an opportunity. Let's say you're doing a call calendar spread, and you don't have a view on where the VIX might be. Second, where the Nifty might be in the next 2 days. So your 1 lakh or maybe that 25,000 would be engaged in the strategy and you'll end up not making money. So yes, can it be done without a view? I would say no, because as I said, there is a match between the premium that we have to select. See, ideally, I'll tell you what happens is there is a deviation and a contraction of the premium that happens in a day. It's ideally, if you're just looking at the screen, we would not really know. So what I mean by this is, if the Nifty is at 15,400 this morning and the premium is 50 rupees for a 15,400 call option, maybe after a couple of hours, even if the Nifty at 380, there are chances that the premium might be more than 45 or it is as low as 32 also. So now this deviation from the mean which happens, it happens throughout the day. So we wait for certain day which happens on a Tuesday and then we select it. So to answer your question, without a view, it would not help because it would be then just a speculation wherein you do not have a view on the market and we are trying to trade the dynamics. There is a possibility of profit, but then again, it is more of a speculation.
Perfect. So we have got a question from Mr. D.S. Murthy. If VIX is more than 25.
Yeah. If the VIX is more than 25, I guess the question is asking, can we do it? If I understand this.
Exactly.
See, Mr. Murthy, the thing here is, if the VIX, first of all, there are only two things that differs for a VIX. When you have the monthly expiry, the VIX T-5, that is when you have the expiry on Thursday, 5 days before expiry, the VIX will take the July option into consideration and not the June. That is the only assumption this VIX has. So what I'm trying to say is, after 23rd of June, 24th onwards, the whatever VIX you see on the screen, the NSE India VIX, it is not about the June option, it will be about July option. So even if the VIX is 25, it is projecting a July movement into action. And obviously, because you do 2 consecutive months, so if you're doing a 30 June, the next option that you will buy would be for a 5th or a 7th July. So even if the VIX is high, it can be done. Rather, I would say when the VIX is high, you end up selling with a higher premium. The amount of money you get can be more than that 60 odd rupees. So if for people who understand options on a very high level, it is a long Vega, long delta, long delta and long Vega strategy, wherein the rise in volatility will help you. And the movement in the Nifty, it's a positive delta. So if the Nifty goes into your direction, it gives you money through that. And because the time decay is at a bigger strategy, it is a short theta. What do you mean by short is you are net selling the option, you are net buying the call option, and in net buying the volatility.
Right. So there is a wonderful feedback from Mr. Manoj Pesala. Mr. Manoj, we will shortly share your feedback with the department concerned, and they will surely get in touch with you, right, for further clarification or assistance or help or any understanding, right? So we have got a question from Ms. Renu Gupta once again. This can be done with put. This can be done with put.
Yeah, absolutely. This can be done with put as well. I'm sorry, Suraj, I interrupted that. Yes, yes, Renu.
No problem. It's really very exciting.
Yeah, Renu, this can be done with any option, which is a call or put option. It need not be only call option. Obviously, the only difference between a call calendar spread and a put calendar spread is we all know that maximum times when the market corrects, your put option makes money when the market goes down. But whenever the market goes down or there is a panic, the volatility index goes up or the IVs goes up. So in this time, where because you are seller of an option also, it is more profitable in a call calendar spread. When I say more, it is just 2 to 3%, which I'm saying it's not really a difference of 20-30 odd percent, and this usually gets squared off in 2 to 3 days. So you end up making 8 to 12% on the margin that you have put for 2 to 3 days. So that 12-13 odd percent might come down to an 8-9%. That's all in a put calendar spread if the entry is not on a perfect premium.
Great, Manoj. There is no more questions left in our Q&A section. We have addressed all the maximum questions that we are able to within the time constraints. So, right, with this note, I would like to thank you, Manoj, for your wonderful insight about this new product on the calendar spread. And I would like to also thank you, all the participants, for joining with us on this amazing session. So, with this note, I'll conclude the session. Thank you and have a nice day. Great day. Take care. Bye-bye.
Thank you.